Good morning, everybody, and welcome back to Money in the Law on my FM 101.3. First Class Radio, 9-time radio station of the free universe.
Nice, yeah.
And also joined here with and Hollis and Cable Access TV, which I think they won an award as well. Something along the same lines, greatest TV show ever.
Yeah, they won an award for carrying our show.
They won an award for great content for our show. I am John Drohan from Main Effort Financial. I'm joined by my illustrious and esteemed co-host, Jay Marsden from the illustrious and esteemed Marsden Law Office. I'm sorry.
Marsden Law Group.
He does financial as well. It's a group. It's a group over there. It's a group of
people. It's a team.
Group of people that is they're making it happen on the legal side of the house. Yeah,
on a regular basis.
On a regular basis. So we're here, and Christian, of course, is in charge of the Hollis and Cable Access TV aspect of our program. And we are Money in the Law.
Yeah.
We talk about all things money, all things law. We bring to you in such a way, and in hopefully an entertaining and enjoyable way, some very important things, very important topics concerning finances, concerning legal matters, concerning estate planning, concerning elder planning, concerning retirement, all that good stuff.
All that stuff that makes you so excited to hear about it.
As you hear it, when we tease it like that, you're moving closer. You're uncontrollably
hairs
moving
in the back of
closer
your neck stand
to the
up.
edge of your seat. And
what
our job is to keep you there.
You're going to pay for the whole seat, but you're only going to need the edge.
That's all you need.
That's right.
That's all you need. And we get that a lot. We get that a lot. Yep. And where we get it is on our website at moneyinthelaw.net. And if that's moneyandthelaw.net. It's all one word. Just cram it together. There's no dots or buttons or dashes.
No, it's all good.
Put it all together, and you can send us some questions. You can send us some comments. You could send us some pictures, but email us there. And we will, if you have any questions, we will get them on the show.
Yeah,
happy to talk
if
about
they're NSFF, we won't do that.
No.
NSFW. That's right. Keep those out of here.
I don't even know what those letters mean, but I do know what WMRC means. It means First Class Radio.
Love it.
All right. So, how you doing?
I'm good. I'm sick as a dog.
Oh, good.
And I have that. You know when you as your day goes on yesterday, and everything starts to hurt.
Yeah.
And it starts to ache.
Yeah.
And then you start to say to yourself, why is it so cold in here? And then you can't
It's called
get
fever.
That's right.
Yeah.
And you can't
it's
get
called
warm.
flu.
And you want to go home, but when you go home, you're like, I want to lay on the couch and watch Netflix for 13
If I
hours.
could.
If I could do that, but I can't because we get 50 million things to do. So that's what I'm doing. That's why I'm bundled up today
And look at you, and you're here.
Yeah.
And you know why? Because you're dedicated.
Committed
to the cause.
Committed to the cause.
You're
That's
dedicated.
Right.
Keep your distance. I mean, the space is nice.
Well, before you got here, I licked your microphone and that doorknob, so you're all good to go. So it's all good. So enjoy that.
Oh, I wish you didn't say that.
And by the way, it's not. I've been told it's not the coronavirus. Not the coronavirus.
That's good to know. That's good to know.
I suffer from a different type of coronavirus, but not the the one that seems to be catching all the news right now.
Yeah, the coronavirus, the real coronavirus, far different, far more serious than the coronavirus that you have suffered from time to time.
That's right.
It's funny. It's funny you mentioned that. So we oftentimes will refer to the fateful Christmas party that happened this past Christmas. And so when I woke up that next day, again, feeling very good about myself because I had a wonderful Christmas party joined by some of my greatest friends. I said to myself, honey, I think I have an allergy. And she said, oh, really? I said, yeah, I think I need to call my doctor and change my medical records. I think I have an allergy to whiskey.
Oh, hey, whoa.
So it's funny. I was just recently at a follow-up appointment with my doctor, and they said, do you have any allergies? And the words were on the tip of my tongue.
Of course they
were. I think I do. I think I have an allergy to whiskey. Yeah, it just makes me really tired. Really funny.
Yeah. Makes me more handsome. Makes me bulletproof. That's right.
And it makes me somewhat forgetful. But other than that, those symptoms, although not incredibly serious, I still think I've developed an allergy.
Well, it's funny. So in keeping with your allergy story, I had helped out a friend of mine this week with nothing that was a heavy lift. Very happy to do it. Happy to help out in any way I can. So then at the end of the helping, he says, what do we owe you? I said, don't worry about it. We're good. He says to me, look, I can either give you money or I give you a bottle. And I said, well, there's no need for either one of those. Well, I appreciate the suggestion.
although I do like both of them.
Although I love both of them. I said, there's no need for either one of those. So magically, as I come out of a conference yesterday, there was a fine crafted liqueur that just magically showed up in the office. And
Do you even drink liqueur?
no, it's not a liquor. It's not a liqueur.
It's liquor.
It's a liquor. It just sounds better when you say it that way, right? So yes. So you know who you are. So thank you very much for that. I appreciate it. That
It's
was
like an anonymous donor.
not
Yeah.
required, not necessary, but we do
Well appreciated.
We do barter. We do barter in the dark liquids this time of the year. when it
And
comes to New York.
the other side of that is that could be medicinal for your current
Well,
current
yeah,
situation.
definitely hot toddy. We've moved into the hot toddy situation. Yeah, so I'll probably
I mean,
work
you
on
probably need a good steady dose of that.
Oh yeah,
And
you can
you'll,
mainline that. Yeah,
Yep,
you hang
and
that
you'll
right
get to
upside
s-
down.
I
Yep.
always used to, and right. So remember, as a kid, are you a NyQuil guy?
Oh yeah.
All right, so I remember, particularly like in college, NyQuil was the thing. If you felt sick, you just need some NyQuil.
Yeah.
Like, and
Yeah.
and there were
Or
like,
if the liquor store's closed and you're out of everything, you just have some NyQuil.
my well, that's if you're really thirsty.
Yeah, yeah.
Because it tastes terrible. But
Yeah.
my room, I had a roommate who he was like an unlicensed medical practitioner. He
Right.
would be like, "Oh, you're sick? Stand back. So this is John Slater, the one from Arizona. He'd be like, "This is what you need," and he would have a whole recipe of this is how you're going to
Get
not
you
be
well.
you're not going to be sick anymore.
Yeah, yeah.
And it always ended with like, I don't know, probably like 16 ounces of NyQuil. Right? Yeah.
Sure. Yep. Take this, sleep for 4 days.
That's
You
right.
might miss your finals, but you'll feel better when
You
you,
know
wake
what?
up.
You're going to be okay.
Yep. That's right.
Yeah.
That's right. That's right.
So maybe the case of that dark liquid, maybe it's somewhat
There may be a need
NyQuil.
for
It's
that.
NyQuil-esque.
Yeah, there might be a need for that. That's right. That's right. That's right.
All right,
So
so-
what are we talking about? What's on your mind?
I don't know things. It's an estate planning thing.
Sure.
You know what we haven't talked about? Probably again. Maybe we talked about it 2 weeks ago. I just don't remember. What about Irrevocable Life Insurance Trust? The old island.
That is old school right there.
This has come up. This has come up this week. For a client who potentially could be facing an estate tax issue at some point if all things go according to plan.
Right. Well, and this could also be a planning technique, if you will, that comes sort of back into fashion, if you will, especially around the changes to the Secure Act that just
we
went
covered.
into play, right? So,
Yeah.
but and specifically around the idea that you can't stretch your IRA out over your lifetime anymore. You get 10 years to take it out. So, when you take it out in year 10, if you've amassed if you inherited a pretty decent sized IRA, you could have a $200 or $300 tax bill to pay to the feds. And this may be a technique that, not that it fell out of fashion, but it just didn't. It wasn't front and center like it had been for years when the tax laws changed.
That's right. So an irrevocable life insurance trust is just as it sounds. It is an irrevocable trust where the trust owns the life insurance policy. So the reason you would do this is because, again, as we've talked about irrevocable trust, many times, once it goes into the irrevocable trust and the trust is truly irrevocable, it no longer is your property.
That's right.
Yeah.
That's
So
right. It doesn't live with you anymore.
yeah, it's not yours. It is owned by the trust. And and we've kind of had this conversation and almost not necessarily debate, although because I would not debate with said lawyer to my left.
Nice.
Is that the idea of, are you the trustee of that irrevocable life insurance trust, or are you the trustee of an irrevocable trust, which is a question that I would have for my attorney, because the whole idea of, if you're the trustee and you have control over this trust, could it potentially negate its irrevocability? If that's
Well, that's a very good point. I mean, we have seen situations where somebody says, Jay, I'm going to set up an irrevocable trust, or they've already done it, and they want to make themselves they want to make themselves the trustee of the trust. We advise against that only because the whole purpose of the irrevocable trust is that you're cutting the string, right? You're cutting the string, which means you have no control over this anymore. Now, that doesn't mean that your trustee, who might be your kid, for example, and assuming all things are equal and everybody's on the same page, for example, the current occupant of the White House put his assets into a revocable trust, all right? And the idea behind that was that he has now separated himself from his business dealings so that there's an arm's length relationship between his business entities and himself.
Right.
All right. That's complete BS. All right, that's absolutely not what's going on.
Is he the trustee of said trust?
No, his kids are the trustee
would
of
imagine,
said trust, but he's the beneficiary of said trust, right? So we've talked about it before. There's three people at the table. There's the grantor, the person who makes the trust and funds the trust. There's the trustee of the trust, person who's in charge of the trust, and then there's the beneficiary of the trust. Right. So to your point, when you use the irrevocable trust, essentially what you're doing is you're setting up a vehicle that's going to hold life insurance. You may not own the life insurance right now. You may go out and buy a life insurance policy. And the idea is that you're going to put this life insurance inside the irrevocable trust, and then it has to sit there, and you got to eat your vegetables and look both ways before you cross the street for 3 years to get that stuff out of your estate, get it off your plate.
Why is it 3 years versus the 5-year Medicaid look back?
Well,
this isn't a question. I was thinking I'm getting free legal advice right now from my attorney.
Well, this scenario contemplates not that you're trying to protect money from Medicaid. This scenario contemplates you're trying to create an asset that's going to pay out at your death to your beneficiaries, who in many cases might be your family or your kids, to cover some type of tax obligation that would also occur at your death.
Yeah.
So it's not a Medicaid, you bring up a great point. The irrevocable trust piece of it is used a lot in the Medicaid planning phase but this year, we're talking about, the reason you'd be doing this problem is because Medicaid is not on your radar screen.
Yeah, you have enough.
You're of means.
You'll never qualify for Medicaid in this situation.
That's right.
So oftentimes we talk about when we talk about kind of like these long-term estate plans and that how the Medicaid piece may fall into it when we talk about putting like your house into an irrevocable trust. And it's funny. So one thing I just noticed is you say irrevocable and I say irrevocable. It's kind of like a tomato kind of thing.
Oh, it definitely is.
Yeah, and we've had this. I mean, for those of you who have been following along for years and years, the RMD, the MRD. Jay and I have these subtle differences, but you know what? It doesn't affect our friendship.
Well, no, but just so you know, so the reason that lawyers do that is because it makes us sound wicked smart. And then that way,
you have to be the smartest guy.
That's right.
Here.
So when we use 3 or 4 different words, it's like the Eskimos and having 10 words to say snow. Okay, lawyers do the same thing. That way they look wicked smart, and then that way they can explain to you.
So smart.
And then that usually means that there's some fee adjustment going on because I use the word grantor, settlor interchangeably. Clients are thrown for a loop.
They ask a few more questions. They stay a little bit longer.
Revocable, revocable. I mean, while they're asking me those questions, obviously the meter's running, which we love. I mean,
that meter's running right now.
That's right. That's right. But the idea is this: when you inherit life insurance, it's not taxable to you. There's no income tax on getting a $250,000 life insurance policy, right? It's just yours. Here you go.
Right. When you get the benefit, right? Yeah. When you get the death benefit, when you receive it, most of the time it's income tax free. So the idea of why somebody would need to use this kind of a trust or need to get their life insurance is because your life insurance benefit, for those of you following at home doing your estate tracking, your life insurance benefit is part of your estate. So when they calculate your estate, they say, hey, my house is worth $1 million. My bank account's worth $1 million. My 401k is worth $1 million. And blah, 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 blah. And let's say all my assets go, but I have $20 million of life insurance. That seems right. So now your estate is $23 million, right? And,
that's right.
And so when the feds calculate your estate tax for when you die, for when you leave that estate to your heirs, they take off the $11.8 million federal exemption, and everything after that is taxed at 40%.
Yeah, that's right.
So what a lot of people don't realize, and then we're just talking about the federal estate tax, which many people will fall well under that exemption threshold of 11.8. But there's the state estate tax, right?
That's right.
The Massachusetts death tax, or however you term it, but that's real money, and it's not. We're not talking millions of dollars, but it could be.
Yeah, it could be a couple $100,000.
Hundreds of thousands of dollars that people could be on the hook for. not wittingly knowing it, because they've accumulated. Their brother-in-law is a life insurance agent, and they've had life insurance. So
so the way this usually works is you'll put together this life insurance trust, or this irrevocable life insurance trust. You'll own the life insurance. The actual trust itself will own the life insurance, and then you'll have to make premium payments on your life insurance, right? Unless it's completely fully paid up. So what you'll do is you'll write a check every year to your irrevocable life insurance trust to cover the cost of the premiums. And that money, that check that you write, is covered by the annual gift tax exclusion
love that
you get just by, the feds let you give X amount of dollars to anybody. So one of those anybody's is your irrevocable life insurance trust. So if you put $1 million policy in your trust, to John's point, now it's not in your name. So if you die, it's not part of your estate, assuming it's been there 3 years. Then you're going to write a check every year as part of your premium payment. Whatever that premium is, could be $8,000, could be $9,000, whatever it is. You are going to write a check,
a lot.
right? And then you're going to write the check, and that's going to cover the premium. And then you're going to wash, rinse, repeat. You're going to do your thing, right?
Yep.
And then at some point down the road, if you pass away, the taxes that your family would then have to shell out to the feds because of the size of your estate, or to the state because of the size of your estate, they will have that money through a life insurance policy. And in many cases, this serves a real purpose, because if they didn't have that money that you had put into this life insurance trust, they may be forced to liquidate portions of the estate that they just inherited to come up with the estate tax bill, right? Because the feds don't care. You got a big house down the Cape, right on the water. It's worth $6 million. Guess what? You owe us, pick a number, right?
$200,000.
That's right. And then everybody looks around and goes, "Where are we going to get the $200,000?"
That's a great point. That's a great point in how it enables you to have not only remove something from your estate, but have the liquidity of insurance, which I'm going to leave us hanging on that. We're going to take a quick break. We're going to come back because I want to talk about that. That's actually, my colleague has brought up a very, very important point. So even though he's a little under the weather, he's still bringing it. Christian, I saw you yawn twice. Any more yawning out of you, you're coming over on this side, and you're going to be,
It's all right.
There's no yawning.
There's no set.
Maybe it was a long night. I mean, it's
big night.
Yeah, it's Wednesday.
Tearing it up.
All right, we'll be right back on Monday in the Law. My FM 101.3. Don't go anywhere. We'll be right back.
And we're back. Money in the Law, My FM 101.3. Jay Marsden, Marsden Law Group. John Drohan, man for financial. Christian, man on the con. Me hanging on for dear life. But we're doing well. We're halfway through. We're good. We're just going to manage through the back nine.
Before we get back to the Irrevocable Life Insurance Trust, or the ILET, I want to, do you have any New Year's resolution? We haven't talked New Year's resolutions. It's now February. Which, you got, I know you got some business stuff, right? I know you're...
It's funny. So, on the business stuff, they always ask you about
if he coughs up a lung, Christian, I'll be able to get that back.
They always ask you about the business stuff, but they always want to know about the personal stuff too, right?
Right.
So, from a personal perspective, one of the biggest things that I promised myself I would do this year was I would work on this is going to sound a little bit up in the air, but I work on my mindfulness.
Wow.
Yes.
Yeah.
Yes. And the theory is this: trying to spend more time in the moment.
Exactly.
All right?
Right?
Not doing this, by the way.
Yeah.
That's not in the moment. Right?
What he's doing is he's on his Instagram or his Snapchat. Yeah.
So make it a point. You want to look at your phone? Look at your phone for 15 minutes, then put it away, and then spend time doing something else. Right.
Right.
So it's that concept of mindfulness. I'm reading a book right now, and the focus on the book is about the fact that, and you can appreciate this, in our world, you don't win. You win in business, but you don't win like you win at a soccer game and you go home and you say, victory is mine, right? We're all done. That's right. That's right. It's an ongoing process. It's an ongoing project. And so, it's this whole idea of, how do you make your, get your portfolio life, if you will, laid out so that, you're paying attention to the right things at the right time, and it's not just focusing on. It's easy to get pulled into that stuff that when you think about it, you say to yourself, "This is really not helping my mindset."
Right.
So it's a lot of that stuff.
How does an elder law attorney win? Like when your client when their estate plan that you've so carefully put together and monitored over the years actually gets executed. It doesn't feel like a win.
It's not
at
a
that
win
point,
for them.
right?
It's not a win for them.
Right.
They come in your office
Yeah,
and
yeah.
you go, congratulations, we're going to use
Congratulations.
that estate plan.
Uncle Al died.
Way
Yeah,
to go.
There we go.
I
right?
told you this
Thank
trust would
goodness
come
we
in
put it
handy,
together,
huh?
right? High fives, everybody, right?
Chest bumps
Fist
all
bump,
around.
right?
Chest
right.
bumps all around. No, I mean, it's about,
I know
it's
what
this idea of, it's this sort of portfolio life approach, which is, be grateful for all that you have, and then, spend time on grow your business. You want to spend time with your family, but don't pick the task, and be present in the task, and don't just, don't. It's easy to say, oh, I'm just gonna flip through this phone while I make dinner, and then the kids are like, what are you doing? I'm like, oh, I got to check the news because something might have changed in the last 8 or 10 minutes, right?
Yeah.
It doesn't happen. So
it's easy to do,
That's
right?
right.
It's easy to try and do more than one thing, and fortunately, I've learned kind of, I don't have really the ability to do two things at the same time,
Right.
Just because I'm not smart enough. I'm not gifted enough. I'm not talented enough.
Right.
But it's funny that the whole idea of mindfulness, and it sounds a little, mindful, and there's
Sounds
a lot.
a little new age.
There's
It
a lot.
sounds a
There's a
little-
lot of that
yep,
going
sounds
around
a
where,
little new
where
age.
you kind of look down. You roll your eyes, say, oh yeah, I want to be more mindful. But the concept. I mean, some people take it to they're a little over the top. But the idea, I think you're absolutely right. The idea is, look, be in the moment and enjoy that, because one thing, that moment is, and again, I don't want to sound too fluent or whatever.
New agey.
Yeah, is that it's never coming back, right?
That's right.
So one of the things that kind of hit me is when I was coaching the kids, right? So and I would tell the kids, I'm like, look, you guys, and kids, like, they got to be at practice, they got to be at the game, and it's always kind of like a chore to kind of get, and a task to kind of accomplish all these things. But I would try and tell them, and again, this was after years of not really realizing it myself. It's like, look, this group, this picture that we have right here, it's never coming back.
That's right.
Like, it's never going to be. We're never going to have this again. You're never going to have this exact team, this exact age, this exact time in our lives.
Yep.
So it's very easy to kind of look past that and be distracted, or to try and look, and as opposed to saying, okay, here we are, appreciate it. You don't have to dwell on it. It doesn't have to be like something that's going to anchor you down or slow you
No,
up.
it doesn't have to be heavy, but
appreciate
it.
But appreciate it, and give it the just time that it deserves. And you probably realize when you start doing that, you're like, wow, I feel like I'm in a better mood. I feel like my relationships seem a little bit more at ease. I'm not arguing with my children as much as I was, right? So,
Well, we've all done it. I mean, you've ever find yourself in a situation where you're sitting in some public area, if you will, and you're on your phone.
yeah,
and
the
you're-
phone's a big
and you're
distractor.
pulled into what's on your screen, if you will. And then at some point you either stop, or you have to put the phone away because you got to do something, and then you kind of look around and you realize what you're missing, all this stuff is going on around you, and you weren't sort of paying attention to it. So, it's not the phone. It's not just the phone. It's just about being more intentional about sort of how you kind of live your life. So that's it right there in a nutshell. That's it.
Wow.
That's
I
it.
wanted to lose 10 pounds.
That's a little
but
different. Yeah, that's pretty quick. It's good. It's pretty good. Yep.
I mean, yeah, Jay, that's a really good resolution.
That's heavy,
All
huh?
right, we're gonna all
That's
try and be like Jay. All right, that's it.
Yeah, email the show. Email the show. Tell us what your
WWJD.
Tell us what
That's
your
what we have.
resolutions are for 2020.
All right, so if you find yourself in a situation where you happen to have a good amount of life insurance,
Pile of dough.
a good amount of money, or you have perhaps some potential liquidity need when your estate eventually gets settled, 100 years from now.
Yep.
One of the things you may want to consider is what we've been talking about, is an irrevocable life insurance trust. And Jay, before the break, Jay brought up a great point about how the idea of a need for liquidity, and maybe not to pay a tax, or maybe not only just to pay a state or even a federal tax, but just the idea of having liquidity for when when you're making the transition after somebody has passed away. And we have an example in our practice. We had a client that just passed away. And again, their income comes via pension. Their income comes via Social Security. So the idea is that there's still income there, but there's some bank accounts that have to change. There's some kind of administrative things. But what my client also had is he had life insurance. He
Yep.
had and so all of a sudden, again, they have, his wife gets or his estate gets life insurance, like boom, boom, like
Right.
like right
Well,
away.
the turnaround is pretty quick, right?
It's very quick.
You send the assuming there's nothing hinky, you send the life insurance company a death certificate, and they send a check.
That's exactly
Pretty
right.
quick turnaround, right?
Yeah. So you're talking like usually about a week.
Yeah.
Like a week. That once it's confirmed, and like Jay said, there's no, it hasn't. They haven't bought the life insurance 3 weeks ago, and then they passed away,
Right,
and or there wasn't any, or the cause of death wasn't
no
anything.
suspicious death, things
wasn't
like that,
wasn't
right.
suspicious. So yeah. So then you have this instant liquidity. Via the life insurance policy. So the idea of having it be in an irrevocable trust is that as long as the trust is set up correctly, and of course if you use the Marsden Law Group, they probably know how to do that down there.
Yeah.
You bet they do. As long as the trust is set up correctly, that estate is going to have the ability to they'll have access to liquidity. In Jay's point, what if the estate is primarily real estate or something illiquid or something,
That's right.
something that they're, so and all of a sudden the estate tax is due. And it's not like the estate tax is due the next day, but
Right.
once the estate tax has to be settled, and you say, well, there's a $200,000 estate tax. We'll use that example on a $6 or $7 million property that you inherited, and you're like, well, this is Mom's house. This is the house we've been going to for the last 20 years. We're not selling this house.
That's right.
Because first of all, no one can buy anybody out because
That's right. Too much money.
Yeah.
That's right. That's right.
And second of all, it's where we go. And now it's like it's our what Mom's legacy, what she's left for us.
And the liquidity piece, when I worked at that small mutual fund company in town,
Green is their color.
green is their color. They would always talk about liquidity, but they would always talk about liquidity obviously in the big scheme of things. That you needed to have $1 million liquid, $2 million liquid. You have these outlandish policies that would pay out these substantial amounts of money. And to your point, it doesn't have to be a huge estate to have a real need for liquidity, right? And $100,000 that hits the table 2 or 3 weeks after somebody passes away, that's going to go a long way towards helping keep the Cape House running, keep the main house running, pay some of the bills,
Give funeral expenses.
Give funeral expenses, give you some liquidity to play around with some things here, so that you're not, because what happens is that those bills got to get paid. And as terrible as your situation is, for the most part, businesses and other companies and municipalities, they're sensitive to your loss, but you still get a property tax bill. Right. You still got a water bill. You still got a gas bill. You still got an insurance bill. So you need liquidity to do that. And yes, some people can. Some people say, look, I'm going to get the house anyway. I don't mind writing the check. I'm happy to do it. Other people, not so much, right? It's other siblings who can't afford it the way you can. That becomes a real issue. You got to worry about that.
It's like Jay's. He's like a balloon. He's like a helium balloon that's like running out of air because his compromised respiratory. Yeah.
I have a question for you.
Yeah.
So when you're buying the said insurance, if you're a couple, is it 2 insurance policies on each person, or is there a way for me to get one policy?
You could do what is called a second to die policy.
Oh my God!
This is a rhetorical. He knew the answer to this. For those of you at home, Jay's he's just playing. He was testing me. It was a quiz. I got it right.
Nice.
Yeah. Because I'm the only licensed insurance guy actually in this room. But
nice. That's right. That's right.
So if you're a couple and the idea is you want to leave the death benefit, the insurance policy for the purpose of just what we had been discussing before, estate tax or state estate tax or just general liquidity for your heirs, you can use what's and there's a husband and wife still all alive and kicking. You can use what's called a second to die policy, which is nothing more than a life insurance policy that has two two life insurance that the policy is written on. So you have both the husband and the wife.
They do sort of a joint life expectancy calculation, right? And they say, all right, based on
which is really the wife, right? The woman.
Exactly.
Yeah,
that's right. Because they always outlive, right?
She's going to, yeah.
So, but the idea behind that is there's no taxes when the first spouse passes away because you get a full marital deduction, passing the money
That's
back
right.
and forth.
That's right. That's why one of those can go into your irrevocable life insurance trust and qualify for it, because there's a 100% marital deduction. So the idea is that after the second person passes away, then the life insurance gets paid. It goes into the irrevocable life insurance trust, and then the trust then goes. Then the trust is executed at that point, and the liquidity is there. So here's my question to you. So talk to me about what that irrevocable life insurance trust, like how is that constructed? Like tell me the pieces of it.
Well, I mean, generally speaking, the pieces of it are, there's the person who makes the trust, right? So in this case, mom and dad make the trust. They sign the trust. They name the beneficiaries of the trust. They sign everything. Now you have a trust, right? And it's literally that simple. I mean, to create a trust, you get a trust document. You say, look, I'm the grantor, I'm the maker, I'm the person who created the trust. This is who the beneficiaries are, and this is who the trustees are. And you put some rules in there. And then when you sign it, it's notarized. Now you have a trust document.
Yeah, and that's the important thing, is that the great thing about the trust is it has these rules. That's what a trust is, right? It's got these rules. It's got it's got the purpose. And we always use the analogy of that a trust is a box, and inside the box is the instruction list, right?
That's right.
And then it says this is what's going on. This is who's in charge of this trust. This is who gets everything that's inside this box.
Yep.
This is who gets it, and this is when they get it, and this is how they get it, and this is what they can do and what they can't do with it.
Yep, that's right.
And the important thing about the irrevocable trust is that, and we had alluded to this earlier in the show, is that if the grantor, what makes it irrevocable is that the grantor no longer owns that property. So in the case of the life insurance trust, the grantor they don't own that policy anymore.
No.
The policy is owned by the trust. The policy is essentially governed by the trust, and all trusts have what is known as the trustee, and the trustee is the person who's in charge of that trust.
So when you create the trust, then you're going to go to SBLI, and you're going to say to the people at SBLI, I need some change of ownership paperwork, because right now my life insurance policy is in my name, and I need to change the policy so that the owner of the life insurance policy is my trust. Mm-hmm. And people kind of get a little wigged out about that. And so you just think about it. It's no different than just, if I had a change of ownership policy and I had an insurance policy and I said to the SBLI people, I want to change the ownership so that John owns the policy.
Yeah, he does.
Right? John owns the policy. I fill out the change of ownership paperwork, and John is now the owner of that life insurance policy. And with that ownership comes certain rights and responsibilities, and he can then do that. I am no longer in a place where I can affect anything that he does.
Right, but the important thing to remember is that even though Jay has given me ownership of the policy, he is still the insured person on the policy. So
That's
it's
right.
still, so it's not like he gives me the policy and now I'm the insured. Now it's my life. No. It's Jay. So it's still based on when Jay gets hit by that piece of Skylab or that 3-round burst when he's coming around the corner, kicking indoors, in the zombie apocalypse. Imagine, do you think life insurance is going to pay out during the zombie apocalypse?
I'm sure there's a zombie rider. You pay
Sure
extra for it. You pay
I'm sure
extra for
there's
it.
a zombie rider. If I become a zombie, there's going to be.
If I eat brains, does this policy pay out?
I got to look into that.
At my death.
You
Well, the question would be, is when you die and then you turn into a zombie, there's like that window, right? It doesn't happen like you transition.
Yeah, you have to get paid in that window.
But there's like a you did die,
Yeah.
right? And then I don't know. I mean, anybody in the audience who does this for a living, if you could tell us what the chemical makeup of how your body turns into a zombie and what that transition looks like, and like,
Which is real.
Are you dead for a second? Are you dead for a minute? You watch it on
Yeah.
TV, right? They don't just turn. Well, sometimes
Depending
they do.
on what show you're watching.
That's right,
So it
that's
depends.
right.
So if it's World War Z, you're talking
You
15
become-
seconds.
That's right. That's right.
Yeah.
But I think that's the question. I think that's what you need. You need that. You need that. Like at the time of my death, prior to my transformation or transition into a zombie, I want the beneficiary of my policy to be this person.
So you have to get. So actually,
Like some policies,
actually the insurance companies will eat that up.
Well, some zombies don't. You don't die. Some zombies, you just become a zombie. You don't become dead and then a zombie. You transition. Like you make faces and then you start.
That's
pulling,
World War Z.
You start pulling your
That's
face
World-
off,
that's
and then
World War Z.
you start.
Now, Walking Dead's different, right? If you're
That's
if
different.
you're a
That's-
Walking Dead zombie,
that's kinda what I'm
there's some
thinking.
downtime, right?
That's right. That's right.
So
Because they always have time with the knife. They always have that window of time where you're dead. so they
Yeah.
can ice you and you don't become
That's
a
right.
zombie.
That's right. They stick the
right.
ice pick in your
That's right.
brain.
That's right.
Scramble it up.
That's
and
right.
then
So I don't know if that's a rider that you have to pay for. I don't know if that's. I mean, that's what you'd have to lawyer it up. Is what you would do. That's what you'd have to do. You have to lawyer it up.
You know what? As fun as this is, because I could go all day and talk the legal ramifications and the idea of the insurance ramifications of zombie insurance, and just how this would work. Because you think about a life insurance company, if they'll insure you, right? They'll say, hey, well, technically you didn't die.
Well, that's exactly
all day long. They'll sell those policies all day.
Well, and that's what insurance companies do, right? The first thing they say is no, right?
Yeah.
And then they wait and see who comes back, right? So they figure if we say no first to 100% of the population, 30% might not come back,
Yeah.
right? Now, maybe they come back as zombies. I don't know, right? I mean, I would imagine as the insurance company, if you say no to enough zombies, they probably talk, right? So they probably know, right? So at some point they're gonna they show up in I Am Legend, right? And they attack his house. They would attack like the SBLI headquarters in Woburn or something like that. And that's what they would do. They
Exactly.
would we want our policy
They're-
payouts, right?
They're at American General down in Texas.
That's right.
Banging on the door. Yeah.
That's right. That's right. So that's a different.
And we don't know if SBLI or American General actually do have any of these zombie riders, because these zombie riders, to my knowledge, do not exist.
I don't believe they exist. I don't believe they exist.
I don't know if we have to put a disclaimer at the end of the show today.
But I'll
to
bet
say
you,
that
I'll bet
everything-
you, there's language in there that could be interpreted as zombie
Oh,
language,
a good
because
lawyer,
that's what lawyers
good
love
lawyer
to
will
do.
that.
That's
Yep.
right.
Good lawyer will do that. Whoa,
Now,
whoa,
now
whoa.
until
Hold
now
on a
until the
second.
world end,
That's
right? Now until the world end is that discussion.
And that's right, and that's the insurance lawyers, like
That's
those
right.
guys, because their job is to send as little money out as possible.
Oh, you think being an estate planning attorney is exciting? How about an insurance lawyer?
Yeah,
I mean,
those
talk
guys
about
are-
partay.
All right, so we're back to reality.
We digress.
So in the idea of one of the other things that we talked about was with the Irrevocable Life Insurance Trust is the idea of you having some sort of an estate, right? You have an
That's
estate,
right.
meaning you have money, you have sizable assets, and maybe you have sizable assets enough to where you even exceed the federal exemption, right?
Sure.
So there's but at least most people that we know don't exceed that federal exemption. You know, they're kind of your normal average American don't have more than $11 million of an estate. Now, that doesn't necessarily mean that they won't have an estate issue, because there is the state estate tax, which is another thing that if you have enough assets, then you could be required to pay that estate. So,
And remember, most of these taxes are due upon the passing when there's one person. So going to husband and wife, going from wife to husband, you get a full marital deduction, and there's no taxes.
Yeah, this is for the
on
estate
surviving
passing
spouse.
on,
This
right.
is when you're trying to get it from the survivor of you and your spouse to your kids. To John's point, that's where the 11 million-ish issue comes in, and that's where the point. Now, by the way, you got to qualify for life insurance, right? So if you're listening to this at home and you've got a raft of health issues, this solution may not work for you. I mean, you do have to qualify. There is underwriting. You do have to qualify, and they're going to say.
Yeah, that is always a stipulation with insurance, is that you have to be able to be insured. You have to be insurable.
Yep.
And then the other thing is, oftentimes when people start thinking about estate planning, they're not thinking about it in their 20s or their 30s. They're thinking about it more in their 60s and 70s. And then, if you say, "Well, I'll get a life insurance policy then," and you go to your life insurance agent down the road, and they say, "Sure, come on in, Mr. Jones. You're 72, and you're pretty healthy. That means you're going to qualify for life insurance." But guess what? Even though you're a very young 72 in the life insurance world, you're not young.
Right.
You're not young. So it may be financially unreachable for you.
It can be cost prohibitive. It's not worth it. Not worth it to do it, right? So you have to think it through a little bit. And again, the other piece of this, and this isn't financial. This isn't, we can talk all day long about, how much my, $300,000 life insurance policy is going to cost, and we can spin that out.
Haggle those numbers all
Yeah,
day.
we can spin that out into, ad infinitum. But the question then becomes, do you even care? All right. I mean, we've had.
Does it matter? Right?
That's right. Do you care? And when I say do you care, not that you don't care, right? I'm not saying that that money's not real, but some people will take the position. Look, if my kids inherit $11 million, and they have to write a check to the government
he's not getting broken up. It's not, it's
some
okay.
number.
That's right.
Some number.
This is make believe. This isn't.
I
real.
get emotional.
This isn't real.
I get emotional when I talk estate planning. If
every time as clients, it throws them off a little bit, but it means that
right.
their lawyer cares.
That's right.
Their lawyer cares.
You may not care, especially on the state side. You may not care about the state number.
Because it may be a number, it may be something that, like, okay, so let's say the estate, the bill due for the estate taxes, call it $50,000, right? So let's say that's kind of what the number, or even $100,000, and you have, $1 million inside of an IRA, you have a $2 million house, and you have, $200,000 in a savings account or in a checking account or in a brokerage account, right? So in that respect, you're like, okay, you know what? Here's what you got, guys.
Right.
If it's going to cost you $100,000 to get this, $2 million house and $1 million IRA, you know what? There are worse things that are going to happen in life. You can figure it out. I mean, one of the things, the idea, what kind of carries the day for the Irrevocable Life Insurance Trust for me is the idea of, okay, if the life, and we always talk about this, life insurance has to have a purpose, right? You're not just buying it for the sake of buying it. Sure. You're not just buying it because someone said. So if the life insurance, if the idea is that I want to leave a legacy, or I want to leave some liquidity, or I want to be able to cover a certain expense that I want, not for my wife, right? Because if it's in an irrevocable life insurance trust, my wife isn't going to, it's not money for her or for my husband. It's not money for them. It's for my heirs, my children, my grandchildren, or something like that, right? So the idea is that I want to put this life insurance, I want them to have it, but if I just have a life insurance policy that's not in the trust, then it's part of my estate, and therefore it's going to cost me. It's going to increase my whatever my death my death taxes or my expenses at the end. So if I know I want them to have it, then why wouldn't I put it into an irrevocable life insurance trust? So long as that it makes sense, and I'm willing to kind of give up control of that policy. Sure. I'm willing to give up. I don't need to change anything. Now correct me if I'm wrong, but I do think you do have the ability to adjust beneficiaries inside the irrevocable as long as it's within the stipulation. So let's say for whatever reason, we've kind of given this example before. Let's say whatever that you say, well, okay, if I have a $500,000 life insurance policy and I have 5 children, but my one son is he discovered Instagram, so he doesn't really need that money, right? He doesn't need my $100,000. He doesn't need my help on this. But my other children, you know what? One may need it more than the other, or there may be one may be living in the house. Whatever the situation is, you may want to kind of change the numbers inside there based on events in life.
Right, but some people might say, look, I don't want the complication that goes with this, right? And I don't want to deal with setting up the trust because, first of all, and some people just don't want to pay the money for it, right? Some people say, look, I don't want a complicated estate plan. I don't want to have to worry about writing because it takes some coordination. You got to write the check every year to cover the premiums. You got to change your life insurance policies into the trust. You got to get a tax ID. Some people don't want the headache of going into this plan, and they say, look, I don't really care. When I'm gone, if they get $6 million and they pay something to the state, it's not the end of the world, right? Grand scheme of things, not a problem, not a big issue. That's how you do it.
Yeah. Again, it's one of those things where if you kind of advance it a little bit even further and say, okay, let's say you have a sizable estate, you have a good size estate, right? And I go back to the illiquidity. So if I'm over the federal exemption, if I'm over the 11 million change federal exemption, that means I probably have some real money, right? So
but you bring up a good point. What does your estate consist of? If your estate consists of real estate, you're not going to have any liquidity, right? You're going to have a ton of real estate, and someone's either going to have to go out and get a loan or sell a piece of property, and maybe it's a fire sale because they need the money to pay the tax bill because Uncle Sam doesn't wait around for tax money. Or do they have a big IRA? Do they have some life insurance policies that might get them there that just never made it into it?
That's right.
So a lot of it does depend on what's the makeup of your estate, and that's a conversation that you have with your trusted advisors who can sit down and say to you, this might make sense to think about.
Yeah, and usually if you're talking about a sizable estate, at that point it only makes sense if your intent is to provide some liquidity to your heirs, to that estate that they're going to inherit. it only makes sense to, and you have life insurance, and life insurance is how you're going to do that. You said, I'm going to do it. It only makes sense to use an ILET or an irrevocable life insurance trust to do that because A, it reduces your overall estate, so that part isn't counting your estate so long as it's in there for 3 years, and B, it's going to the same people. All it is just goes into the trust, and then the trust distributes it as written inside to its beneficiaries.
And just so you know, I mean, when people buy life insurance, a lot of people will buy a term policy when they're younger with the idea that, oh my God, if I pass away, then this policy will pay out to my family. But the goal is to own this policy until I have a chance to establish an estate. And the life insurance is designed to create an instant estate if I'm not around. That being said, you're buying the second to die, or you're buying the life insurance policy that you're putting into your irrevocable life insurance trust because you know you're going to die.
Yeah.
Right? You know. I mean, you're not saying I'm buying this just in case I die. You're saying
someone's getting this money. Yeah.
That's right. That's right. You're buying this because you're saying when I go, someone's getting a check,
yep.
and that check is going to be used to pay my taxes or pay the estate taxes. That's the purpose of doing it. So this isn't like I'm doing this as a belt and suspenders and hope I never use it.
Right.
You're saying, I'm definitely using this. This is a whole life insurance policy. You're keeping it until they carry you out of the house feet first. And then when they do, they get that money and they pay the taxes.
There is a good chance, again, barring the zombie potential that we discussed earlier,
at length,
there is a good chance that you might die someday, right? And hopefully much later than now, but yeah,
chance, yeah.
there's a I mean the odds are against you in that, unless again the zombie thing comes, and then that's a whole different animal.
Right, but the odds are ever in your favor. Is that how it works?
That's true. That there's that Hunger Games aspect too, which we can talk about next time. I don't even know how I can fit Hunger Games into this irrevocable life insurance.
Is there a Hunger Games rider? If I get picked at the quarter quell, does that make me like? What is my like? There's a whole actuarially.
This is so fun.
This could be. This
This
could be riveting radio.
We need to get the what's the closest insurance company around here? SPL? No.
Right.
Oh yeah, we could get an insurance agent.
Great Steve Ellis.
That's right.
That's right.
We could get Steve Ellis in here to talk actuarial of A, zombies, and B, Hunger Games.
Can I get this?
We'll talk about Hunger Games next time. So right now you're getting off the hook. It's time for you to go back to bed.
All right. Back to Netflix.
That's right. Back to Netflix. Back to NyQuil.
That's right. That's
all right. So we're done on Money in the Law, My FM 101.3. We talked about irrevocable life insurance trust. Fascinating stuff. Christian stayed awake for the second half. Jay stayed alive for the second half. We'll hope you join us next week. I'm not sure. There may have been a time difference. Maybe there was like a daylight savings thing that happened. But next week, usually we're on at 9 o'clock. But we're on Saturday, so come and make sure you listen to us. And as far as cable access
Saturday,
TV,
9 a.m. Key West time.
Yeah, that's Key West. Right. That's this time zone. We'll see everybody next week on Money in the Law. Jay Marsden, John Drohan. See you next week.
Have a great week, everybody.